Anyone can get rich in the stock market. Simple Rules for Beginners 2022. One of the best things about investing is that it only takes one great purchase held for a long time to change your future. Decades of holding stocks in companies that generate ever-increasing earnings can result in enormous fortunes. The days of only financial experts making investments are long gone. The stock market is now available to everyone via digital platforms and smartphones. It has evolved into a welcoming environment for even the most inexperienced investors to learn, invest, and profit from. But especially if you're looking to get rich quickly, great potential rewards comes with great risk. If you want to try your hand at short-term or aggressive market strategies, keep in mind that you could lose all of your investable funds. So in today's video, here are some simple rules for beginners to make money with stocks, because anyone can get rich with the stock market. Before starting, remember to subscribe to our channel and hit the bell icon for getting the latest updates. Let's dive right in. Number 1, plan and invest. The first thing to remember is that unlike mutual funds, buying individual stocks carries its own set of risks and rewards. Before investing, make sure you have a plan and a capital amount in mind, as it is a slow and constant process. Protecting your capital by analyzing your risk appetite is one of the most important factors. Think about the long-term implications of your investments rather than blindly following the high-risk, high-return philosophy. Determine your loss-bearing capacity per trade when deciding which stocks to invest in. This will aid you in devising a buyback and exit strategy if the market is declining. Make sure you diversify your investments as well. If the bid price of one stock fails, it should maintain its balance. Investing in a variety of stocks can also help you earn more money in the long run. Number 2, understand the market. If you're a new investor, you should be aware that stock market fluctuations are impossible to predict. Even the most experienced investors can't always predict market behavior. It's critical to comprehend how markets work. If a stock price rises one day, there's a chance the bid price will fall the next. As a result, it's critical to comprehend the factors that influence the stock market. Even experienced investors make mistakes when it comes to investment decisions. In this case, make sure to concentrate on long-term investment returns rather than short-term losses. Number 3, be realistic. Amateur investors frequently anticipate higher returns right away. For example, expecting to make a profit of more than 100% on stocks every year is unrealistic. On the other hand, 20 to 25% returns are a possibility. While some investments may yield high returns, it is important to make prudent investment decisions. The first step toward making informed and strategic investments is to set attainable financial goals. Also, stay away from schemes that promise high returns in a short amount of time. Make sure you do your homework before investing. Number 4, avoid leveraged instruments initially. New investors should begin with cash equities and avoid leveraged finance. Leveraged investing is a strategy that entails borrowing money in order to increase investment profits. The difference between the investment returns on borrowed capital and the cost of interest is used to generate these profits. Profitability increases, but so does the risk of losing money. As a result, investing in futures and options entails a higher level of risk for the investor. Number 5, start simple. When it comes to stock selection and strategy, many young investors go overboard. It's necessary to keep things simple in order to maintain financial stability. Make your analysis as straightforward as possible. The stock market, as previously stated, is a highly volatile environment. You must, however, make certain that your reactions do not reflect the market's volatility. Make sure you never make hasty or impulsive decisions. Rather than panicking over the stock's performance, you should develop and stick to a broad strategy. Number 6, use index funds. It's a little unrealistic to expect to become wealthy by investing in just one stock. This is why index funds have become so popular. When you invest in an index fund, you're diversifying your portfolio. Your investment in each fund is automatically smaller because you're investing in a variety of companies in one fund. As a result, each company pays you less. However, if some of the companies turn out to be loss-making, you will not lose as much money. Because index funds are tax efficient, you save money as well. Index funds are more tax efficient than actively managed funds because they have a lower turnover ratio. Because of the low turnover, shareholders rarely have to pay capital gains taxes. More importantly, index funds typically outperform actively managed mutual funds in terms of returns. Make sure to compare expense ratios when choosing an index fund to invest in. Index fund investing is decent for the buy and hold strategy and getting rich in the stock market over time rather than seeking the one stock that will change your life forever. Number 7. Buy and hold. Investing in and holding a stock can be extremely beneficial to your financial situation. Buying stock shares and holding them for the long term, even when the stock market is down, is referred to as the buy and hold strategy. Most famous investors use and recommend the buy and hold strategy. Investing and owning good companies for long periods of time is how money is made in investments. Number 8. Short selling. Short selling is the polar opposite of the buy and hold strategy. People who want to make money in the stock market in a shorter period of time do so by shorting stocks. The basic idea is that you borrow stocks and sell them at current market prices in exchange for cash. However, because you only borrowed the stocks, you'll need to replace the one you sold. You're also responsible for paying dividends for the time you've borrowed the stock. Short sellers hope for a sharp drop in the stock price so that they can buy it back at a lower price. This means they can take the difference home with them. Short selling is a way to make money in the stock market because the difference can be quite large at times. Shorting the market necessitates market knowledge and an educated guess as to when the stocks will fall. You don't want to borrow them for an extended period of time because you'll end up owing a significant amount in dividends. Number 9. Contribute and upgrade your portfolio consistently. Consistently contributing to your investments over time is a great way to build wealth in the stock market. It's a budget-friendly strategy for an average investor. Many people do not have large sums of money to invest at any given time, but they do have smaller amounts that they can contribute over time. Consistency is a wise investment strategy. Let's say you start with a $3,000 investment. If you invest $500 per month for 30 years at 6% interest, you'll have $523,022 in your bank account. At $1,000 a month for 30 years, you'd have $1,027,897. You can use a calculator to see how different levels of monthly contributions affect your investment returns, and you can use an automated investing service if you're just getting started. Number 10. Choose an investing style. Choose whether you want to invest actively or passively. Actively managed funds are managed by professional money managers. These professionals actively rebalance the holdings of mutual funds. Actively managed funds allow you to delegate some of your investing responsibilities, but they can be expensive. Passive funds are much less expensive than active funds while still providing high returns. You'll also have to decide how aggressive you want to be with your investments. Calculate how much money you have available to invest. Make a list of your objectives, such as how much money you'll need in retirement. This will have an impact on how aggressive your portfolio is and how long you plan to stay invested. If you begin investing at a young age, you should have a more aggressive portfolio because the market will have more time to recover from any downturns. As you get closer to retirement, you can shift your asset allocation to a more conservative one. Long-term investing allows you to benefit from the power of compounding to grow your wealth. When you reinvest your dividends, you increase the number of shares you own while also increasing their value. Number 11. Buy and sell individual stocks. Buying and selling individual stock shares allows you to earn much higher returns than buying mutual funds that include a variety of stocks. You can buy stocks without paying a commission with today's competitive brokerages. It's also a highly liquid investment that gives you more freedom to customize your portfolio to your liking. You have complete control over when and how you buy and sell. Many platforms now allow you to buy fractional shares, ensuring that your money is always fully invested. Stocks are more tax efficient than mutual funds because you can control the timing of capital gains when you buy and sell. You could start with companies you've already heard of. Conducting stock research is necessary. You'll need a starting point to determine which stocks to investigate. If you're just starting off, consider seeking advice from professional stock picking services on which stocks to investigate. Only sign up for investment newsletters and other services that have a track record of success. You can more than double your money if you use the most reliable services. We hope the video was helpful and you learned something new. Let us know your thoughts in the comments below. Do like and share with your friends. See you in our next video. Till then, happy investing.